Hello everyone, welcome back to my YouTube channel. In today's session, we are going to talk about accounting principle. Accounting principle is basically a set of rules and regulations which we follow while preparing our accounting statement. Okay, so let's get started with today's video. Accounting principle is the basic norms and assumptions developed and established as a basis for accounting system. So it means that we are preparing certain set of rules that has to be followed, and plus we are assuming certain things. So these two things are nothing but the accounting principles. Why we are doing it? To establish a basis for accounting system. For any accounting systems to be followed, we have to have certain basic norms and assumptions that is prescribed in the accounting principle. It provides uniformity and consistency. Yes, because there are several companies in a nation, right? So if each one accountant is going to prepare in his own way, it will not be in a uniform manner, right? So in order to bring in uniformity among the companies and also have a consistency in preparation of accounting statements, we are having something called as accounting principles, right? It is also called as GAAP. GAAP is nothing but generally accepted accounting principles, which is accepted all over the world to have a uniformity in preparation of the financial statements, right? It could be a concept or a convention. So these two things are very important. Accounting principle is in general. It is subdivided into two, that is concept and a convention. So let's get started with concept first. What are accounting concepts? Accounting concepts are basic assumptions or conditions upon which the accounting was built. That is, it is a basic necessity to form an accounting system. We are assuming certain things and we are having certain things or certain conditions over the accounting system. So the accounting concepts are nothing but the basic assumptions and the conditions upon which the accounting is built. Second point, it provides uniformity to the accounting reports and processes. So it allows us to have a uniform and consistent way of approaching with the accounting process, right? So there are around 10 very important accounting concepts. We'll discuss about this one by one. The first one is business entity. Business entity is that the owner of the business and the business are two different people. Okay, so the owner is, it's like the separate legal entity thing. Okay, so the owner is different from his own business. There are two parties here, right? The business entity is different from his owner. Yes, only the business transaction has to be recorded and not the personal transaction. So while we are recording in the books of accounts, we will record only the transaction from the perspective of the business and not from the perspective of the owner, right? So that's why here it is mentioned only the business transaction and not the personal transaction, right? Next one, money measurement. Money measurement concept is, it is only the transaction which has the monetary value shall be recorded. For example, can you record something in the value of, see, even if you're calculating and you're, giving for depreciation, still we are calculating in the monetary terms, right? Only when it is in the monetary term, we can record it in the books of accounts. Anything that is not in the monetary terms will not come in the books of accounts. That is the money measurement concept. Third concept, going concern. The business will continue for a foreseeable future. That is, no matter what, the owner may come, the owner may go, the managers may come, managers may go, but still the company keeps going, it keeps flourishing. There is no end to that company. Okay, so it means it will continue till the foreseeable future, till the future it continues. That is the point. Fourth one, asset shall be measured in the historical cost or acquisition cost. That is, say for example, I'm purchasing a machinery for rupees 50 lakhs and I am happen to have an installation charges of 5 lakhs. So actually the total cost shall be 55 lakhs, which I have to mention. This is my historical and acquisition cost. Acquisition is nothing but you are purchasing something, so that is your acquisition. For acquiring that asset, you have incurred certain cost. That cost has to be recorded. So I will record in my books of accounts stating I have purchased machinery for 55 lakhs. So that is the cost concept. Dual aspect. Dual aspect, again, we would have studied in a in our previous session, it's nothing but the double entry system of accounting. For every debit, there shall be a corresponding credit. It is the basis for accounting equation. I'll prepare an exclusive video for accounting equation. It is nothing but for every debit, there is a equivalent credit. That is the concept of dual aspect. Periodicity. As the stakeholders want to know about the company's performance, the financial statements are prepared every accounting period. See, I'll prepare my books of accounts this year, then I'll prepare my books of accounts after 5 years. Will that be a consistent thing? No, because we should know about the performance of the company then and there. At least yearly once we should understand about the performance of the company. That is why we prepare the financial statements, right? Every year. Every year we prepare the financial statement. Every year we prepare the annual report because we should know about the performance, how it is actually performing. Is the idea actually working out? Is my investment safe in that company? I should come to know about that, right? So for that purpose, we have to maintain a periodicity. For example, if I'm preparing my accounts for a year, yearly once if I'm preparing, I should do it. If I'm preparing 6 months once, then I have to follow it consistently, right? So that is the meaning of periodicity concept. Moving on to the ninth one, matching concept. Revenue during the accounting period shall be matched with the expenses during the accounting period. Okay, so if I'm having certain expenses this year, it has to be matched along with the revenues of the current year. It cannot be matched with the previous or the upcoming year, right? The expenses and the revenues of the current accounting period shall be matched, right? So that is the concept of matching concept. Eighth one, realization. Any change in the value of asset has to be recorded only when the business realizes. So it means, say for example, I am buying a new machinery, additional machinery, right? Worth rupees 10 lakhs. So when will I actually account this? The moment I purchase it, right? The moment I purchase it, the moment that machinery is actually reaching my premises, I'll record it in my books of account. I'll not record it when I'm actually planning, when I'm thinking of buying an asset. At that time itself, I'll not happen to mark it in my books of accounts. I will do it only when my business is realizing it. I am the one who's taking care of the business, right? So if I'm planning to buy a new machinery, I'll not go just right away write it in the books of accounts. I'll write it only when the asset is realized into my business, right? So that is the realization concept. Objective evidence. It means all the transactions shall be recorded along with the objective evidence. For example, see, during the end of the year, okay, so when the audit is actually conducted, the auditors will first check the vouchers, the receipts, and all the transaction which has evidence supporting that. Okay, so in order to have an evidence that is supporting everything, we should formulate a record has to be maintained. For example, if I'm purchasing something, I should have a proper receipt for it. I should have a proper invoice for it. Same way, if I'm making any expenses, I should maintain that voucher clearly. Only then it will be easy for us to keep track on our expenses, and also it will be easy during the auditing period, right? So objective evidence is nothing but having an evidence for everything that we do in our business, right? And the 10th one is accrual concept. Accrual concept is the transactions are recorded when they are incurred and not when they are paid or received. For example, if I am making the payment for my employees for the next year, that is, I'm giving an advance salary, right? That salary is actually pertaining to the next financial year, but I am giving an advance to my employees, right? So, since I'm actually paying it now itself, right, it cannot be recorded in the books of accounts. Of course, it will be recorded uh, as an asset because you are already paying it, right? But still, it is for the next period, right? So next financial year, it belongs to the next financial year. That is the concept of accrual. We have to record it whenever we are incurring it, okay, right? And not when we are actually paying it or receiving it, right? Which means if there is an insurance payment, right, and my insurance subscription is actually due, I'm yet to make my insurance payment, right? And then I have to make payment for my insurance company and I am not doing it. It's outstanding. It belongs to the current financial year. Right, I'll record it in my books of accounts stating that I'm yet to make the payment for that particular thing. But I'm making the payment in the next financial year. Then also I will have to make the entry. But you should understand here, they should be recorded only when they are incurring and not when you pay, when you receive does not matter. If you're incurring that payment or a receipt, you should make the journal entry and rest of the transaction entries there, right? It has to be recorded when it is incurred, and the date of payment, the date of receipt does not matter, because we are making the incurrence. When the incurrence that has happened, right, at that moment itself it will enter in the books of accounts, right? So that is the accrual concept. Moving on to the accounting conventions. Accounting conventions refers to traditions or usage. So how it was before. Convention means old times, right? So it refers to the tradition or usage, how it was previously. It is a practice which is followed as a guidelines in preparation of the statement. It is nothing but a guideline for preparation of the statements. It makes the financial statement more realistic, reliable, and useful, right? It is making the financial statement more realistic, reliable, and useful, right? Okay, there are totally 4 very important conventions. The first one is consistency, full disclosure. Third one is materiality. Fourth one is conservatism. Let's go through it one by one. Consistency is accounting rules has to be followed consistently. For example, this year if I'm following for depreciation SLM method, and from the next financial year I'm following WDV method, am I being consistent enough? No, I'm following different rules for different accounting period. Then there is no consistency in my books of accounts, right? So once you have chosen something to follow in your company, it has to be followed for a longer period. If at all, if you're going to make changes in your rules, it has to be clearly mentioned in the financial statement, and also it has to be made notice to the readers of the financial statement, right? So it has to be followed on a consistent basis. Next one is full disclosure. Full disclosure talks about the accounts must disclose full and fair information. That is, it should include all the necessary details that has to be told to the readers of the financial statement. It should contain everything full and fair. It should be true and fair, right? It has to be truthful, and it has to disclose everything that is essential, right? So that is the full disclosure convention. Materiality. Relatively important and significant monetary transactions shall be recorded. It is important that we record the monetary transaction, and now also whatever that is important and significant, that has to be recorded. For example, a company that is making a turnover of 500 crores will not bother so much about their stationery worth rupees 5,000, right? To that company, that is a immaterial amount. Say, for example, a company which is making a turnover of 5 lakhs. For them, the sum worth of rupees 5,000 or 50,000 matters a lot. So, materiality concept depends upon the company to company. It is nothing but whatever that is relatively important and significant. If that amount is relatively important and significant to the company, then it has to be recorded in the financial statement. Next, conservatism. Only the prospective losses shall be accounted and not the prospective gains. Say, for example, I am anticipating that I'll incur more bad debts in the next financial year. I'll create a bad debts account now and I will actually record it. Same ways, I should not record the prospective gains, because we are having that conservatism concept, right? We will record any anticipated losses, but we will never record any anticipated gain unless and otherwise it is receipt, right? Only when you incur it, you will record the gains, right? Only whenever you are anticipating, you will record the losses. That is the conservatism convention. I hope all the accounting concepts and conventions are clear. Thank you so much for watching my video. Subscribe for more.